What is a 1031 exchange is a question that we answer for clients every single day. 1031 exchange is part of the tax code that allows owners of real estates and some other assets to go from owning, in our case, buildings, one building or two buildings or five buildings, sell those to a third party, and then go out and buy another building. And from the IRS's perspective, it's as if nothing has happened. You're not paying any capital gains taxes. You're not having your basis change. You go from one to the other. In reality, actually exchanging, my warehouse for your apartment building and finding that one off really isn't very practical. And they figured that out. And so what they created was this 1031 infrastructure. What you're allowed to do is, let's say it's a warehouse. You sell your warehouse to a third party. The money goes in with a qualified intermediary. Who's going to hold that money for you. You'll have 45 days to identify the next property. You'll have 6 months after the closing date of your first property to actually go ahead and buy that next property. We'll keep digging into the rules here. The property that you buy has to be of equal or greater value to the one you sell. So let's say you sell $1 million property. You're going to go out and identify another $1 million property. You also have to take all of the equity and put it into the new property. So let's say you had $500,000 on debt on the $1 million building you just sold. You're going to go buy a new $1 million building, take $500,000 in your equity, the cash that came out of the sale, get a new $500,000 loan. Now you've got a new $1 million building that balances that debt and equity from your old property. You're also allowed to scale up. So something a lot of our clients like to do is they'll sell that $1 million property, take the 500 grand, go to a bank, get, instead of a $500,000 loan, they go out and get $1.5 million loan. And with that loan, they buy a $2 million property. Now you don't own a $1 million building, you own a $2 million building, which is a great way to continue to build your portfolio through the years and get bigger and better properties. A lot of people think that you have to buy something very similar. They hear the word like kind, right? So the 1031 like kind exchange, and they think, oh, I got to buy another warehouse or I got to buy another 3-family. That is not the case. What it means is you have to go out and buy other real estate. So it needs to be a real property with a deed that you own for investment property purposes. So you can't go out and buy a vacation house that you're going to live in 100% of the time on day one. There's certainly ways that we see clients though go from industrial into single tenant net lease retail, where you can buy a property that has zero management responsibilities. That's a great way to take advantage of the 1031 exchange. You upgrade your lifestyle, maybe not your cash flow, maybe yes, your cash flow, but you're able to go from a building that has the toilets and the termites and the leaks and tenants complaining, you buy McDonald's, and they just pay you every month. It shows up in your account. You don't have to do anything. The roof goes bad, they pay for it. The building blows all the way in a hurricane, them and their insurance company pay for it. So with all of these things, you're in this terrific opportunity to stay in the real estate business, stay invested, avoid taxes, but get rid of all the headaches and really enjoy your retirement is oftentimes what our clients are doing. So what do you need to know about a 1031 exchange? A, ask someone about the 1031 before you're at the closing table. We work with our clients prior to even listing the building so that they can understand what they're going to do with the money. Oftentimes that means doing 1031. Sometimes that means just taking the money and putting it in a bank account or with your fidelity advisor. Or it can mean investing in a Delaware statutory trust, which is another form of 1031 that we can talk about another day. It can also mean giving the money to your children or donating it to charity. You really want to have an understanding of the full project before you go and sell your building. At the very least, you need to call the 1031 qualified intermediary a couple days before your closing date. If the money hits your account at the end of your real estate transaction, you sign the deed, they wire it into your personal account, you can no longer do a 1031 exchange. I get at least 1 or 2 calls a year. Harrison, I just sold my building, we want to do a 1031. If it's not with the QI, you've lost that opportunity. What else do you need to know about the 1031? What can you buy? Right? So you do a 1031 exchange, you don't want to pay the taxes, you want to sell your building. You buy a wide variety of things. We see people buy vacation rental properties on Cape Cod. We see people buy these net lease properties with 10 or 15-year leases to minimize their management requirement. We see people buy actively managed properties where they know they can go add value again and then do another 1031 to go add value to another property. And we see the Delaware Statutory Trust, where you can own a fractional share of a larger building or portfolio buildings. This is another great opportunity for people that really don't want to do anything from a management standpoint. It's 100% passive. You're locked in for 5 years, but typically at the end of that 5 years, if you give them $1 million, you'll get $1.2 million back, right? So you're earning cash flow and you are watching yourself grow your nest egg. In summary, when you look at a 1031, the most important thing, have the conversation before you've sold your property. Once you sell, you can't do anything. From a rules standpoint, 45 days to identify the property, 6 months in total to close on the property. It has to be of equal or greater value to the one that you are selling. You're allowed to buy one property or multiple properties. And typically people use this rule in order to avoid paying capital gains taxes. That's what the rule is for. The other great thing that I'll leave you with, there's something called a step up in basis. So when you pass away, your children will inherit your assets, typically with this stepped up in basis, so they will never have to pay the capital gains taxes. So the real magic of the 1031 exchange, you defer and you defer your taxes. Many of our clients have done 10 or 20 1031 exchanges in their careers, and you just stay in the properties, and then your kids inherit the building. And if they want to sell it, they don't pay taxes. People call this the swap till you drop mentality and methodology. The 1031 exchange is a great tool. It's one of the biggest benefits of owning investment real estate versus stocks and bonds. And we're always happy to talk with people about the details of how a 1031 exchange can help you.